Good day, everyone. Well, we're seeing the bounce struggle to continue here. We've seen some pretty exciting action in terms of junk off and ugly duckling type stocks make the most price progress. That reminds me of other situations we've had some years ago in this QE environment, or rather a relaxed low interest rate environment. The thing of it is that while there are powerful arguments that argue for the bounce to roll back over again, we might remember that those other bounces that were led by junk often persisted longer than we thought. And so, at the end of the day, price is all that matters. And right now, the markets are telling us that on an intermediate term level, the trend is up. So, we look at, the lack of leadership, stocks like Facebook and Google, that's a really ugly pattern on Facebook. It's just a weakening wedging pattern. Google is having a tough time just getting above its 50-day moving average there. And therefore, it's a market where it's best to focus on call it the ugly duckling phenomenon that we've talked about. There's a lot of ugly duckling stocks out there that are the ones that make the most price progress. The issue there, though, is if they're that ugly, there is always a danger that they could gap down on an unexpected news announcement. So some of you may be trying your hand at these, but you have to be selective in position size wisely if you're holding overnight, because you don't want to be caught in a gap down situation with any of these ugly duckling stocks. Of course, we still are focused on quality, but quality is very rare and hard to come by right now in this market environment. It does seem like as far as the markets in oil, oil looks like it may have put in a double bottom of sorts, or a firming bottom. But again, the issue is, well, is the global economy really turning a corner? Is there going to be a lot of demand on oil? And the answer is not really. So what's going to push the price of oil higher? That remains to be seen. I mean, I guess what we are witnessing here could be a technical reaction, because it's been so pummeled. It was at over north of 100 just over a year ago. So it went all the way down to about 25, 26. I think it bottomed at 26 and change, and now it's right at around 35. So it could have a little bit more spring in this bounce. Same with the overall markets. But it's very important to be very fluid in terms of market direction, because, like I said, you got arguments going both ways in terms of whether this uptrend persists or whether it rolls back over. So as always, you got to keep stops real tight. And with these pocket pivot reports that we've sent out, as we advise, it's better to buy in weakness. So therefore, your exit point is maybe 1 or 2% loss from where you're buying, as opposed to buying it when it's showing a lot of strength, in which case your exit point might be several percent away from your buy point. And we all know that the canceling method advocates 8%, but in the last few years, 8% would chew your account apart. So you want to keep the risk absolutely to a minimum. That is the basis of the fixed volatility model. It has scored a number of fast gains intra-signal, in between signals, typically over 15%, and I'm thinking of instituting that as a possible rule or semi-rule. Although, again, when you have that 15% gain, I know some of you have taken profits, and they're fast profits. They happen in a day, typically. I'm thinking of maybe making it a little more concrete. Yeah, sure, there might be some 20-25% gains that you leave on the table, but at least you're getting 15% of it. And that number, the 15%, is striking because it seems that's the way these volatility, the UVXY tends to trade. It tends to whip around a lot, but when it does have a move on the basis of the model's buy signal into buying UVXY, it has, and we've seen this a number of times since the model went live, has these quick 15% gains intraday. In going through all the back tests, yeah, it actually would have further improved the performance of the model to take those gains. So anyway, that is something that's on the table. Right now, I'm probably going to continue to just take the model's full signals without taking the 15% profits. But of course, it's all members' decision to take some profits when they have their 15%. In other words, whatever that price of UVXY at the time the report is sent, just add 15% to that, multiplied by 1.15, and see what the price is, and put it on your alerts. And if it hits, then you have a very comfortable, high-class option on whether you want to take some profits off the table there. And then, of course, the downside on like I was saying about keeping your stops tight, as you've seen, the VIX model is very, very disciplined about taking profits and, well, rather taking the fail rates so that it reverses back to cash. Typically, whether it's typically between break even and 1.5%, maybe 2% maximum loss. So you don't get stung on any particular signal. But when you do hit a good signal, or you do take a 15% intraday profit, that completely overcompensates for the small, tiny little losses in NICs. And with that, we'll turn it over to Gil. Gil, your mic's not on.
I know. Give me 1 second. I've got to check something real quickly. So what we know about this market for sure, I think, objectively, is that it's basically a jobs, junk off the bottom type of rally, or at least those are the stocks where you're making the biggest gains if you're trying to play them. And I think it boils down to one simple problem, which is, if you want to write a book on how to make money in stocks, well, how do you make money in stocks in this environment? I think it's learning how to apply certain setups to stocks that are rounding out the lows of a base or bouncing off of recent oversold levels. So I think in general that's really what you're looking at. I'll give you guys some insight into what I'm doing just so you get an idea. One of my favorite names here is Solar Edge, which I have to admit I gave up for dead just a few days ago. But we all know that what you think in the market one day can change very quickly, and you have to be open to the potential for that change. So when I saw this thing start to turn on Tuesday, I'll make that Monday, in a market environment that was kind of dicey, it was moving up, and I'm sorry, wait, that is Tuesday. You can see that the thing was able to get back above the 20-day line, and what I really wanted to see was a move above the 50-day line as some confirmation that it might be turning. Because if you look at this on a weekly chart, and I think this name, if the market keeps rallying, I think this has a fair bit of potential. And I think I've talked about this before. It's because it already had a big run-up after the IPO. Let's make this a little bigger. Nice weekly chart for Sedge. So it came public, had a nice run-up. There were pocket pivots in here to buy, and you could have made some money. But then it blew apart, and along with the rest of the solars, which have come down a fair bit. And now it's forming what looks like the right side of a pod. Now the positive thing here is that most pods, punch bowls of death, which become shortable, is that the move back to the upside, it has the same sort of ascent in terms of its shape and duration as the original descent. Sometimes it's a little shorter, a little longer, but for the most part, it will come straight back up. And you're not seeing that here. It's actually taking some time to pull in and sort of work off some of the overhead here and bring in some stronger hands. Because the fundamental story here is very strong, and I've thought that for a while, but the technicals lately have been kind of dicey. And it's a sloppy pattern to some extent, but if you study it closely, what you'll see is you have an above volume week here. That would have been 8 weeks ago. So that would be right here. Let me get my pen here. So this week here, and you can see that's above average volume here. Now you get a heavier volume week here on this pullback, and you close well up into the upper half of the daily trading range. Your close is up here. And now you pull back in, and again you come off one more time, and notice how volume picks up right here. Hopefully you guys can pick this up. But you're closing at about mid-range, and I'm going to guess above 40% or so, which is usually, when I was back at O'Neill, that was usually evidence of a supporting week. So you are seeing some very subtle supporting action in the stock on the weekly chart, okay? So if we look at the daily chart now, you've got this big pocket pivot. We put out the alert this morning before the open, or was it yesterday, Dr. K, or this morning? I forget. But definitely before the open today, right?
It was yesterday. We put it out, yeah.
And so you had a chance to buy it this morning. It came down as low as, now let me pull up the data window in here, as low as 27.28. So, you know, the 200-day is sitting there at like 27.05 this morning. And, you know, that's close enough to buy it. I know I had bought some down in here yesterday, and as it was shooting up, I sold into this and held a smaller position overnight. And again, this is what Dr. K is talking about. I'll keep my risk to a minimum overnight, hoping to catch a pullback to rebuild my position the next morning. We got exactly that. So the stock's up 14 cents. It's been a little higher, but I think you can expect that it's going to run into some overhead here. So I'm very interested to see how this thing holds up along the highs of this range. And it's really the highs of this sort of choppy, sloppy base formation. So yes, you could say it has some elements of a fractal looking head and shoulders. You could also say it has a look of a fractal looking reverse head and shoulders if you really wanted to get tricky with it. But I think for the most part you can just take the daily action as it is and come to the conclusion that this is a pretty strong stock. So, but it's mostly junk off the bottom. It's in the lower part of its pattern, so IBD is going to tell you you can't buy that. It's improper. You got to wait till it gets all the way up to back up to 40 so it can blow apart on you once you buy it. So you know, I think you got to buy them down here, and you got to figure out how to do it, because if you can't, then the old saying, that's probably my saying, adapt or die, means you're going to be dead pretty soon. So and I would also go back, remember I've talked about Mobileye as having a big move after the IPO, and it broke down, and then it formed a pod, and it was a short up here, and we were on top of that when it shorted. We talked about it in the webinars, and the stock just blew apart. Now it comes all the way down here. Well, actually, this pod, so this is what I think Sedge might be capable of. SolarEdge might be capable of this, and it's like Mobileye. It spent some time consolidating over the past couple of months, and Mobileye did the same thing back in the early part of, or in the first half of last year. So I think that SolarEdge could have potential for further upside if the market keeps going. Otherwise, you know, we'll see what happens. But getting back to the ugly duckling thing and keeping Mobileye on the screen here, we can see that yesterday you had a bottom fishing pocket pivot in Mobileye at the 50-day. And a few days earlier here, you can see that we had a huge volume move here, and it was a reversal sort of at the 20-day. So you get this deep doo-doo sort of pocket pivot here at the 20-day and the 10-day lines. And the stock continues higher, and it turns higher here and reverses again at the 50-day yesterday and post pocket pivot. So I think if you see this pull into the 50-day, it might just be viable with the idea that it's going to continue to the 200-day. And I think there's a number of these out there that look like that. So let's go back to my normal mode here. Let's look at another stock I've been playing on the long side is Workday. They came out with earnings on Tuesday or Monday after the close, I guess, and stock initially looked at in after-hours trade like it was going to open down the next morning, but then by the next morning it was gapping up right up to the 66 level in the 50-day moving average. I actually tried shorting it there first, and as I was shorting it, I noticed that there really wasn't any selling coming in. There was a strong bid underneath the stock, and you could see it on the 5-minute chart on that day. So I just flipped and went long, and the stock launched higher, and it looks to me like it's headed to the 200-day line. And I've been working at buying it back intraday on the 620, using the 620 chart rather, and then selling it into the close, and then buying it back again today, and just kind of working it that way because it is a volatile stock. it does have the potential to roll back real quickly if something happens in the market. So you kind of want to be pushing this, you know, on a tight leash. But right now, it's one of my bigger positions. It's up $1.50 in a down market. So another one is Twitter. Twitter looks like it wants to have a pocket pivot today. It's coming back above the 50-day moving average after finding support along the 10 and the 20-day lines. But you can see here, it got fairly oversold. And if we look at my charts here on the HDSI, whoop, you can see that you've had three distinct clusters of these oversold bingo bars. That's one of Ian Woodward's indicators that he came up with. But I found it useful when you see a cluster of these and something is just hated like this, that if it's able to come up and set up again, it might have some upside. It's actually my best performing position today. But it looks like it's going code blue here, and it's going to head higher. The projected volume level is showing here. I don't know if you guys can see it. Let me make it real big. But you can see this greenish bar here, sort of day-glow green, matches this one over here. It's higher than any down volume over the prior 10 days. So it looks like it's setting up for a pocket pivot. We'll see how it closes. But so far, the thing is jamming along, and it's acting pretty well. I actually bought it a couple of days ago off the 20-day line, and it's worked out pretty well. My guess is it probably doesn't have a lot of downside in it. From here, I think you can use a 50-day line. It's around 1855 right now as a maximum downside stop. So that looks interesting to me. Another one is Salesforce. And this one gapped up as well. I thought it was a short. I shorted at the 50-day, got a little bit of love, but you could see as it's coming in on Tuesday, there was the volume was let's see, where are we? It was drawing up here. What day is this? 1, 2, here, and the volume was drawing up on the selling. It was able to retake the 50-day line. So that looks to me like it might go higher, maybe to the 200-day. But that's very V-shaped, and it's getting into an area of overhead. So we'll see what happens there. But again, these are the stocks having the better moves, and if you're on them, you know, you can be doing okay. The other ones that I'm looking at here, I'm not long any of these, but Ambarella is trying to turn. Watch Netflix, it's still hanging out. It's hanging around the 10-week moving average. This one I don't give as much of a shot at moving higher, but yeah, this is what's working. So this is what I'm going to go with. You can even look, I've been watching names like this, Vulcan Materials. Look at that. That's turned and continues to go higher, and it looks like it's forming a big cup. I think, though, once you get up to the highs, it's a little bit late. And meanwhile, you have stocks like Fab, and there's a Bible gap up, and that's such a pretty chart. You know, you look at it on the weekly chart, and it looks like a nice tight base, but it's going nowhere. It's busting. And I had a position in that. I dumped it because it's not holding the 20-day line. Look at this one, Light, Lumentum. This has had a couple of pocket pivots in a row, and now boom, right back to the 10-day line. My guess is somebody probably downgraded them. But you can see that, you know, what looks like a nice chart pattern, a pretty chart, doesn't work. It's the ugly duckling that's in full force here. So I'll go through some other names that I'm keeping an eye on here. Look at Square. And this, I think, is coming up with Workday and Salesforce, which are both acting well. This one's suddenly turning around. And I guess you could have said it had a pocket pivot. I don't know if this qualifies. 905, let's see. No, this would not qualify as a pocket pivot. It's just turning. You know, you get this turn, it's just turning higher. But I think it's probably moving higher with the group, which is Workday, Salesforce. I think Splunk might get tossed into that as well. That looks like it wants to push above the 50-day moving average. So you know, these might be where you can, you're making your best money if you're trying to pick them up off the lows, but trying to buy them, waiting for them to break out is probably going to be a difficult proposition. Dr. K, somebody's asking about gold. Do you have any comments on that? I mean, you can see what's going on. I think it's viable along the 10-day line. It's going to a higher high. Any thoughts there, Dr. K?
Well, you know, gold is, you know, it's a fear play, and I think that it's interesting that it's continuing to go higher despite the markets going higher as well. You know, this huge reaction that it went all, you know, past 120 when the markets were setting new lows is no accident. But I'm curious that that the overall trend since the markets started to bounce has been also going higher. So that to me is it's a bit of a red flag in terms of the sustainability of this bounce. But keep in mind also that gold has so many cross currents that guide its price, and it's highly manipulated by the Chinese, etc. So this just might be on a higher, it might be up to date for various reasons, and it's not, you're not going to generally find the answer in the media because they generally don't know either. The thing of it is that often none of us know. It's just a lot of things that are happening behind the scenes that cause these price movements in gold when it's in these long basing patterns. But one thing for sure is when it does have a pronounced move, like it did from 100 to 120, and that was no coincidence with the markets that were selling off. So I would imagine if we get some sort of scare and the bounce fails and we start to roll over again, I would think that there might be a flight to fear in the buying of gold and propel this higher as a consequence.
Yeah, what I read into gold is that it's telling you that low interest rates and negative interest rates and basically the continued QE process is just going to keep going. And that's what it's telling you right now. We've seen utilities sold off the other day, and let's see here. If we look at the utility index, come on. It sold off the peak, but it's been making higher highs, and it found support yesterday, which to me indicates that you're looking at possibly low interest rate environment where catching yield or finding yield, the search for yield as they call it, is a difficult one, and utilities are one area to look at. And you've seen a number of these, like these water utilities looking ugly the other day. Now you see American Water Works gapped up, and I don't know, do you call that a viable gap up, Dr. K?
Well, that's the tricky thing, is it doesn't have a lot of upside, but in this case, in this particular case, it's certainly bucking the trend of the market, and I think that that it is telegraphing to us that defensive names are in play. Even on this bounce, they have been the ones that are often leading the way, and I think that because the markets are forward-looking by several months typically. I think they're already anticipating that Yellen is going to shift to a negative interest rate stance, just like some of these other central banks have. The period of easy money is not going to be, it's not going to end. I don't see how it can actually. The Fed's painted itself in the corner, so they have no choice but to keep lowering rates, much to the catastrophic detriment of pension funds and insurance companies. And there's going to be a bigger and bigger price to pay the longer this low interest rate environment persists. So these bubbles that are forming, there will be a day of reckoning at some point. It's just a question of when. I think it's going to happen sooner than we think. I think the markets are telegraphing that to us. But here's the tricky part. As I wrote in today's pre-market pulse, that the thing of it is you could get a slingshot effect to the upside where more and more money gets printed, currencies get devalued, and you go to this interest rate environment that's negative. Therefore, where's capital going to flow? It has no choice but to flow into hard assets and equities. So what's that going to do? That's going to push the price of gold higher. It's going to push the price of the Dow, the Nasdaq, the S&P higher. And that is a very, I think that is going to actually happen at some point. It could have started already, but who knows? But let's just say this: if the markets are hitting new highs and we're going in an uptrend and a continuation of this 2009 bull market, I wouldn't be surprised. I think it's going to happen at some point.
So you think we could get another 1999 like bubble run, blow off type thing?
I don't know if I wouldn't say 1999 because we're very different now than we were then.
Yeah, true.
I would say that, well, one scenario would be if inflation starts to get out of hand because of all the money that just takes printed, then certainly you could have skyrocketing markets. I think that's a low likelihood scenario. I think it's more likely that we just have these central banks continuing to push rates lower and lower, and that in itself forces capital into equities and hard assets, real estate, gold, etc. And I think long term is going to be to the upside. I don't think the stock market's going to just streak out of control though. I think it'll be measured, kind of like it's been, since 2009, since we've been in a QE environment in this long-standing bull market, which really ended last year, middle of really 2000 and was it about a year ago? When we had the top put in, and it took a number of months for that top to form. But it was middle of 2015. I think that we've slipped into bear market territory. But again, the wild card is that maybe this bear market is mild because of the interest rate environment, and so we create this slingshot effect so that markets are off to the races again. But by off to the races, I mean something like 2013, 2014, where they're just kind of dragged higher because capital is just forced into equities.
Yeah, I think is Warren Buffett, I saw him on TV the other day saying that if interest rates are negative, then theoretically stocks can go to infinity. That's something I'd like to see. I think that'd be a very interesting thing to witness. So, so with everybody printing, it seems like they're going to drive stocks higher one way or another, or try to. And the question then becomes, what are they going to drive higher? And I think it's really a matter of this sort of rotational view of the market where you see things get beaten down and then they turn around and they're the biggest gainers as everything comes back to the upside. And in the meantime, everything that's sitting up near the top, near its highs and a very pretty looking base is actually going nowhere. So it's more rotational and less trending. So this O'Neill style where you buy a breakout and expect the stock to just continue trending higher may not be the norm. It may be more of a situation like what we're seeing where you have these junk off the bottom type names leading the rally. And if you're going to make any serious money, you've got to figure out how to play these. And, I mean, one of the reasons I went to work for O'Neill, and one of the things I admired about O'Neill, at least that I thought I admired, was the fact that he was all about supposedly watching and studying what the market does and then figuring out, how you actually make money in stocks based on what the market's actually doing. And over time, it seemed like it became more dogmatic and rigid and more a question of making the data fit the model. And we found that doing the model books, if you picked all the stocks that actually had the biggest gains for the year, in order to study whether they had any common characteristics, Bill would toss those out because in his view they didn't fit what he was looking for. So in a lot of ways you're fitting the data to the method to confirm the method, when in fact I think you should take an approach of studying the stocks that actually have the biggest gains in any market period, and then trying to identify what the common characteristics are. And my observations, based on what I've been studying, is that the biggest moves occur in junk off the bottom. So then we look at the groups of these stocks and we try to figure out what characteristics do they tend to show when they're coming up off the bottom. Is that such a hard proposition to at least study? I'd like to think that if Dr. K and I were still working there, that's precisely what would be going on, rather than now going into this direction of telling people when Mobileye is here that they're downgrading it from market outperform to market perform, when anybody who understands my methods for shorting and the punch bowl to death pattern knew it was a short way up here when it was around 50, 60 bucks. So, a little bit concerning that way, but I really think that if we're going to be honest with ourselves as traders and as students of the market, then you really need to be looking at what's working in the market and then figuring out what are the common characteristics, and then are there any specific triggers or patterns or certain types of technical positions that these stocks are setting up in that make them viable, and in a way that allows you to limit your risk by having reference points for potential stops. So an example like with this mobile, yeah, you got a pocket pivot here. I'd love to buy it on a pullback into the 50-day line down around 32 bucks. Would be nice, and then I could use the 50-day line as a quick stop. You know, same thing with Twitter. I'm long Twitter, and I'm just sitting here with it, and I'm using the 50-day. I'm in below the 50-day, close to the 20-day, but using that as my stop, and that works. You know, will it gap down? I don't know. I think a lot of these stocks get so oversold that they tend to not show gap downs when they're so far down. They tend to show big gaps more so when they're further up in their patterns, you know. That's really what Twitter did. They accidentally released earnings on this day, remember, but it would have gapped down the next day. And so you tend to see them higher up in their patterns. So I'm not so fearful of a gap down move when I'm buying something that far down. Yeah, it can happen, but my guess is, and based on the ones that I've looked at, the examples of ugly ducklings and jobs, whatever you want to call them. I like ugly duckling. That's probably a more colorful term, but the ones that I've looked at will tend to show this sort of pattern. You know, they'll come off the lows. You get the 3 bingo bars at least, sometimes only 2 if they're really fat clusters. And you can see you get these bingo bars in here. Hopefully you guys can see them. They're, here I'm going to use my pen again. I like using this. So you have one here, not necessarily a cluster, but a cluster of days, okay, where you have oversold conditions, and so it makes a big thick bar. You got a big thick bar here, and then you got 2 bars here. So you have 1, 2, 3, there's your low. You're setting up along the 10-day and the 20-day line. You're going code blue, where all my indicators, the bongo weekly, daily, the kahunas up and down, because they turn blue here actually, right there. Those are the kahunas. And the force, the 13-day and the 2-day force index are both turning blue for me. So it's giving me, and this is what I'll tend to see, and so it's giving me an idea that this is maybe where I want to go. And I'm willing to take a shot. Remember, you have to lose to win, and part of losing means you might be wrong and have to take a loss, okay? And losing to win also means that you take your loss, you lose in order to keep your money and not lose all your capital so that you can win later on. So lose to win has a lot of different meanings, but it's involved with the idea of just, you see the setup, you take the shot, and you have your stop and you run it from there. And if it works out, you could do pretty well. So anyways, no, I don't see any particular questions on stock. So what I think I'm going to do is let me run through, I have a list of what I consider these ugly duckling situations. So we'll make this real big. And I don't know, maybe I should go to a different kind of chart, but let me shrink this. I'm going to make this disappear. Yeah, that's a little better. Yeah, maybe come in a couple of times. There we go. So hopefully you guys can see that. But here's Apple. Okay, you got 3 bars. Okay, you're starting to bottom out. Now you're turning at a pocket pivot on Tuesday. Okay, so that to me looks like it might be trying to turn. You're running into some resistance at the black 65-day exponential moving average, which is a moving average I use on some of my charts, mostly on the short side. That might be an area of resistance, but for now it's trying to turn, and you can see this ugly duckling phenomenon. We look at Amberell, and now here's another situation. It's just got so oversold that you get this big fat bar here, and it's trying to get back above the 50-day, which it has, and it's actually on track. If you can see the volume level, it's projected to be high enough for a pocket pivot. So if it can come up and off of the 50-day moving average, then maybe it has a shot at a pocket pivot today. Here's another one, Acuity Brands, AYI. Again, you had a couple of clusters here before it bottomed, but this is pretty extreme here, and then it turns and it starts to show some pocket pivots coming up to the 50-day, and it's going higher. There's another ugly duckling. Here's Alibaba, which has had a couple of thick oversold bars. You can see back over here you had several clusters. I'd say you have 1, 2, maybe 3. You could call it 4 if you want to, but you're getting at least 3 to 4, and it's turning, and you're seeing a pocket pivot here off the 10-day line, but now it's back above the 50-day, but nothing else really conclusive. So looking okay, but nothing all that exciting. Baidu is above the 200-day line. It had a pocket pivot 3 days ago. I'm sorry, 1, 2, 3, 4 days ago here, where it came above the 50-day. Okay, Salesforce I already talked about. CyberArk is one perhaps to keep an eye on. It's had a number of oversold bars. It's been coming down, coming down. You're seeing some of the other ones like Palo Alto Networks turning back. I'll get to that one. But yeah, this is looking like maybe it wants to turn. and it's hanging along the 10-day. You're not getting a lot of selling. Maybe it's able to pocket pivot off the 10-day. That would be what I call a deep doo-doo pocket pivot. A deep doo-doo pocket pivot, aside from the potty humor, is a pocket pivot that occurs off the 10 or 20-day line and is below the 50 and the 200. Normally, that's not something you want to buy, but guess what? In this market, sometimes those work. Let's see. Diamond Resorts was another one, and so you can see pocket pivots along the 50-day. It pulls back in and it's coming back out. Expedia, I've been keeping an eye on. See, it's done the same thing, and it looks like it could pocket pivot through the 50-day. Fortinet, similar situation. They're kind of all the same. Here's another one, FXCM. This one's actually moving higher and had a pocket pivot a few days ago, and it's actually going higher. Google looks like garbage, but guess what? It had a pocket pivot 3 days ago on Tuesday. And there it is. You can see it. There's the blue. It's highlighted blue. 5 and 10-day pocket pivots will be highlighted on this particular chart view that is available on HTS Investor for anybody who has the service. I think it's under the Morales and Kacher canned chart views. So what is light dotted line on your HTS? That's a group index. So it's just telling me how something's moving relative to the group. Not really something I look at. But when I had Ron Brown over at HESI create this chart for me, he put that on. So something I could look at, and sometimes it's helpful. But in general, you might just look at that line and say it's confirming the group move, and it's not. So here's Jarden Corp, which is a sporting goods company. But you can see pocket pivot here at the 50-day. It's continuing higher. JD.com, I guess they came out with earnings. They were moving up, and now it's rolling over. So, you know, it's rolling over, not working. Resistance at the 50-day. Okay, I can live with that. So that they don't all have to work. JP Morgan, possibly a shakeout +3, but it would have shaken you all over the place. I actually was shorting and going long this thing back and forth in here. Now it's trying to pop through the 50-day, and yesterday it had a 5-day pocket pivot and pulling into the 50-day. Maybe this turns and goes higher. If the price of oil continues going higher, then I think some of the fear with respect to the banks and financial institutions that have exposure to oil industry debt, I think some of that subsides, and you see some of these stocks rally back. Not that they're going to become bullish patterns. They may just rally up into areas where eventually they become shortable again. But for now, these could rally. So Mobilize, another one we talked about. And look, it's holding in pretty tight on a day like today. I think, what are we down on this thing? Just about half a point, a little less right now. Let's see what it. Let me take a look at this actually. Yeah, about 65 cents. So yeah, a couple of percent, no big deal. Palo Alto Networks had a gap up, and notice how it's holding tight. And this will fake you out if you're a short seller, which you want to think, and it's understandable. But this is something I've learned to avoid thinking. Usually, if something's going to fail at a moving average, it's either going to do it very quickly or you're going to see it bounce along for a while. So all this is doing is forming a tight flag, and volume is declining. So for all you know, it's getting set to move to the upside. Now, if the market blew apart, you might try shorting it here and keep your stop, within a couple, 3% if you wanted to try that. So it's going to be fluid in terms of what the general market does. But if we continue higher, then it wouldn't surprise me to see this continue higher. And you can see the patterns are, you come up to this area, so obviously some overhead in here. It's working through it. And you're not seeing heavy selling coming back in. You had huge selling off the lows. So I think in this case, it may have a shot at going higher, but it's an ugly duckling setup, and it's had one of the biggest moves over the last couple of weeks. So here's Priceline, which had a pocket pivot at the 200-day line here on a gap up, and it's actually continued higher. There's an ugly duckling. Radius Health, I don't know why it is. Oh, I know, because a friend of mine who's a broker is in love with this stock, so he called me about it. I thought this was interesting. You have a gap up move here, and then you hold along the 10-day on the pullback. That's a little bit. This was Rewalk, was trying to come, but it's failing. So as you can see, quality and the big stock status of a particular name might be a factor in some of these, and so some of these little ones don't really work. Shake Shack is trying to turn. Now, this one's been beaten to a pulp, and what was a high over here? Close to this would have been this day, which is 96.75, and now you're back down here and trundling along the lows here, holding above the 50-day and the 10-day and the 20-day. So that actually doesn't look half bad. and maybe it would turn. So I would also, another thing to do on some of these, if you want to make a watch list out of these, is check their short interest. Yeah, like I've noticed Tesla, which I'll get to, has huge, like 28% of the float now is short. I think that's almost a record, but you know, the whole world's short. I think eventually it goes lower, but in the meantime, you can get a hell of a rally on the upside if it decides to catch fire. So, and you've got enough shorts in there to squeeze them to death. And I know that some of the bigger institutions still hold positions in, like Fidelity Contra Fund, for example, still hold positions in it. And they might just decide to jack it just for the hell of it, you know, and then they can drive everyone in and sell to them. Skechers is one holding very tight, and it's a retailer. You're seeing a number of these retailers come back, so maybe it turns. Silica Holdings has turned, and it got a big bottom here, nice hammer low and big volume after earnings, and it turns and goes higher. I believe it was after earnings or after something. And now it's up to the 200-day, but that's a decent move there. You have Skyworks Solutions now, has pocket pivoted above the 50-day line here 3 days ago. That would have been Tuesday, and now it's holding along the line very tightly. TripAdvisor, similar situation. You had a pocket pivot coming up to the 20-day. The only thing is it's still below the 50-day, so this is deep doo-doo stuff. Let's keep going. You guys want to keep going? You like this? Tesla. Same thing. Okay, it's come down. You got a couple of bingo bars in here. This one's pretty thick. And it's bottomed here. The whole world short it. I hate it. Dr. K hates it. So does everybody else. Citron Research hates it. And so maybe the stock's ready to turn and rally back to the 200-day. That could happen if the general market keeps going higher. Now, how do you figure out an entry? Well, it ran into the 50-day, and we put out a short sale report on that. But I also followed up yesterday, I believe, with a report on some of these that you might want to cover on this pullback because it looks like they're going to try and turn and go higher. So it came into the 10-day line, held support at the 10-day line, and now it's trying to push higher, and this could turn. So, you know, you can use a combination of the daily chart and the 620 chart to sort of guide what you're doing with these things on an intraday basis and work it from there. That's how I work it, and I'm very nimble. I'm willing to unload quickly if something doesn't work, okay? I must lose to win. I'm always amazed at how people become so rigid, you know? Like the other day, someone's blogging to me or commenting on Twitter or something that, you know, they want to take an axe to work day on the day that it was gapping up, and, you know, this day. And I tried to short it here, okay, but I can see what the thing is doing. It's in your face, you know, and it's like I was writing last night. It was like a blast of hot air hitting your face, and if you couldn't feel it, you either have no nerve endings in your face or you're just dumb, or you're just too rigid and stubborn to see what's going on, you know, and you can see it. And how do you see it? Okay, fair question. Let me get. Let's see if I can find a 620. I'm going to show you precisely how I saw it. Okay. First of all, I'm short the thing. Okay. That's the number one thing. So I'm feeling either love or pain. So I know some of you kinky people like both of those at the same time, but in stocks, I want love or I want pain, and if I get pain, I'm gone. Okay. So in this case, here we see this is a couple days ago. Stock gaps up or opens up in the morning, and you can see that we get resistance, and I'm going to make this real big. So everybody, we're going to follow it along. And you can see that initially you get some resistance right around 66. So if you shorted it on this move here right at the 50-day, almost exactly at the 50-day, I think, you're thinking, oh, this is going to work. I'm going to make a ton of money. And I got to admit, I was sort of thinking that in the morning that day too, because I have made decent money shorting workday over the past few months. I think since the middle of last year at various periods. And you guys might remember I was shorting it as we were doing the webinar, I believe, on this day in early February, and then it broke down after earnings, or not after their earnings, but I think after somebody else's earnings. I don't know if it was, oh, I forget which company, but whatever. I've been working on the short side. But see, just because I've been working on it on the short side and making money on the short side does not mean I start to think of it as short only. Okay, I'm flexible enough to just look at it as a vehicle. It's a vehicle. It's moving one way or the other. My job is to figure out which way it's moving. So in this case, you know, you open up at 66, and I notice it comes in and it looks like we're going to make some money, and then it turns off the 20 period line. You can see that, and then it goes up back to 66. Okay, then it starts to roll over again. Looks like we're going to make some money. Then you see this bar here as it finds support at the 20 period line, and on intraday basis I could feel this as a strong bid. There's somebody in here who wants this stock, and I don't know if they're a natural buyer or covering it, but all I know is they want it, and they want it badly, and I'm not going to stand in the way of this on the short side. And even better, I'm just going to flip and go long. And so I do that, and the stock takes off, and it runs all the way up to close to 72 by the close. I covered it in here somewhere around 71 or so. The next day it came in a little bit. I was able to buy it back and run it back up yesterday, and then this morning they bring it down at the opening, buy it back, it runs up, and it's pulling in a little bit now. But you get the idea of what I'm looking for on the short side. It always amazes me that people can't see this stuff, and it tells me that either, number one, and hopefully this isn't the case, you're just not fit to invest or trade. And I gotta admit, there have been times during my career when the way I've been trading at any given point in time has made me feel the same way, but you got to work your way through it and figure out how to develop that ability to see what's going on right in front of you and just step aside, because if you step aside, at least you're not going to get killed. And if the thing sets up again, so if workday had failed and I could go back shorted, I would do it. You know, I wouldn't say, well, I was short and I covered and I can't go short it again. Yes, you can. And just like if you buy something and you sell it, you can buy it back again. And it has no bearing on what you did before with the stock 10 minutes ago or 10 days ago. And I don't understand why so many people can't really get that one through their head, but I think that's a real key in, number one, keeping your head from getting ripped off in this market, and number two, succeeding, you know, and being willing to take the right trade at the right time rather than forcing or trying to force the wrong trade at the wrong time. So, you know, I think everyone needs to think about that one and think about working on themselves psychologically, not only in terms of your technique, but definitely psychologically, in learning to be more flexible. And that's what I saw in Bill O'Neill. He could turn on a dime, and he had no real rigid opinions. And I think if you can approach the market like an uncarved block, the traditional Taoist concept of the uncarved block, every time you look at a stock, you're an uncarved block. There's no preconceived notions cluttering up your head, no bias, no idea that you're going to get revenge and take an axe to a stock. Because in case you haven't figured this out already, you really can't. You can only click little buttons and they show up on your screen that you own them or you're short them, okay? All right, I'm off my soapbox for now. So let's look at some, somebody says, yes, good input. The market feels heavy. MCD, Walmart, Netflix, FB, SBUX, job stocks play, but doesn't this let us know that when weaker stocks rally, that rally failure could fail quickly? Not necessarily, because some of the best money I've made in this market has been taking the long side of job situations that are roundabout or turnaround situations, okay? So you see, okay, there's a pocket pivot. It's trying to round out the right side of a base. The idea here is to get in early if this rally continues, so that by the time it's up here and breaking out, you already have a nice profit cushion instead of being another lemming chasing an obvious breakout. Okay, so no, it doesn't tell you anything about what might happen. The only thing that tells you about what might happen is what's actually happening, and that's about all you can know. You know, I'm not in the business of predicting where the market's going. I'm only in the business of figuring out where it's going right now and riding that trend, so, or that move if it turns out to be short term. So, you know, that's basically the bottom line. So somebody says, don't healthy markets follow through and don't let you get in? Define healthy market. I would say in the old days a healthy market did, because the market was primarily trending. These days the market is very rotational and choppy, and it just swings back and forth in huge ranges. And you can see that if you look at, let's look at maybe a weekly of the NASDAQ. I'm mouse challenged here in case you haven't figured that out. I mean, here's chop, 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 chop. Look at that. You know, chop lower. Here's a chop, 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 chop. You know, so it tends to be rotational. And during all these chops, one set of stocks that have been leading blow up, and a new group come off the lows, and then they do that. And so 3 years ago is when I began to realize that the only way to make any real progress in this market is to learn how to buy roundabouts as stocks are coming up the right sides of new bases. So in this case, You see it in certain stocks like ALK. We're seeing it in Workday. We're seeing it in CRM. That's what they're trying to do. It doesn't tell you anything about the quality of the rally. I wouldn't allow yourself to be brainwashed by some of the simplistic concepts that IBD is pitching. But there was a time when that would have been the case. I don't think it's the case anymore. I think the market has more of a random element to it. I think that the old patterns don't really work as well, and the best way to get an edge, which is what we're all looking for anyway, is to find ways to buy what you see, which is, number one, that the rallies tend to be led by these junk off the bottom things, or to be less negative about it, stocks that have become oversold and are now rounding out the lows of potential new bases. That's maybe a more positive way to look at it. And I think that's really what you have to do. So you need to figure that out. That number one, what actually performs the best? The job stocks. And number two is, how do I buy them? Well, we have tools for that. We got Dr. K's pocket pivots. We have the voodoo pullbacks. We've got various techniques and methods for understanding how stocks can turn. And even by using the punch bowl of death formation in reverse. And that's why, when I look at Mobileye as an example for Solar Edge, we see the punch bowl of death here, and it fails and breaks. But after this big break, it had a run from here to here that if you had played it, would have been very profitable on the upside. So I can hypothesize that Solar Edge is doing just that. It's had a big break, and now maybe it's coming up the right side. So there's something on a more macro level that drives my thinking here, in addition to just saying, oh, it's the junk off the bottom. There are concrete ways to buy and handle these stocks, okay? And all you have to do is open your mind to it and stop sloshing around in the mud of the old dogma, because it's just going to get your head chopped up. So someone was telling me that they were at an IBD meetup group or something, and the guy who runs it got all over them. They became ostracized for showing people HCS Investor software, which is what I use. And what I like about this particular system is that it's not geared to any particular method. It's not built around a single method. So if you take MarketSmith, that's entirely built around CanSlim. So I think in these days you want to have more variance and indicators and things like that you can test against what the market actually does. So he was tossed out, I guess, and then eventually the guy had to shut down the IBD meetup group because they were all just getting their heads ripped off buying breakouts all the time. So, and that's not to say anything against O'Neill or anybody there. I just think that the reality is, if you truly are trying to figure out how to make money in stocks, and it's based on what the market is actually doing at any given point in time, not what it did in the 1990s or the 1980s, then you're looking at it honestly and more open-mindedly, and not booting people out of an IBD meetup because they show you a different charting system, which is all it is anyways. Since you are one of the biggest traders at Schwab, do you think you have a following inside Schwab? I have no idea. I mean, I don't know. If they look at what I'm doing, they probably think I'm nuts. So all they know is they make a lot of money. Can you please do a webinar on setting up and working the 620 format? I suppose I could someday. I don't know if I get around to it. I'll think about it. But I talk about it all the time. So I don't. Are you a new person there? If you are, then it's just real quickly. It's very simple. If I can find it, where'd it go? It's disappeared. Come back. There you are. It's very simple. You have a orange, and you can, it doesn't have to be orange. There's nothing magical about the color, but I use an orange 6-period moving average. So if it's a 5-minute chart, what is 6 periods equal to? It's 30 minutes. So it's 30-minute moving average, and you have a 20 period, or what's 20 times 5 is 60, so it's 1 hour moving average, the blue one. And I just use it as a tool. If I'm seeing the MACD stretching to the downside on a pullback, that might be a place to come in. If I'm seeing it stretch to the upside, that might be a place to back off. And it's basically something to interpret with respect to the MACD crosses and where stocks are in their daily patterns. But it's not really a system. But that's how you set it up. 6-period moving average, a 20-period moving average. Both of them are exponential. And then the MACD is set up the same way, which is 6, 20, 9, and then a C on this. So, you know, that's basically how that works. But there's no system for using it, and I think people could come up with their own chart, a 920 or a 730 or something like that. It's just a tool that I've devised to keep me from losing a lot of money on the short side when things don't work. And I have to admit it's worked pretty well in that regard. So it tells me when to cover things as they snap off of lows. And that's basically what it was originally designed to do. And I can have figured out that I can use it to handle stock positions on an intraday basis in terms of finding cover points for shorts or entry points for shorts and vice versa for longs. So anyways, anybody else? Maybe we could do a whole book on that, Dr. K. The 620 chart. You can throw in all the stuff you've done on that. Will it sell?
That would be. There's a lot of work there.
Yes, we could milk it. I saw one review on the first book that we're milking the title of the book. The publisher came up with the title and the 18,000% thing in there because they knew it would sell books. I mean, publishers, that's their business, right, to sell books. We didn't really come up with it. Our part was the O'Neill Disciples because that's kind of an inside joke, as I explain in the new book on short selling, where Kevin Martyr, our colleague Kevin Martyr, coined us as the disciples in a book he wrote back in 99 or 2000. Anyways, but it's funny, and then people think we're milking it. Let me tell you something, people. If you want to get rich, you're not going to do it writing a book on the stock market. So unless you're Stephen King and you're writing these horror novels that people buy in the millions each time, and then maybe you're making a living at it. But otherwise, you're not making big money selling books on the stock market. You might make enough just to cover your expenses, and that's about it. Anyways, where are we? Market down 54. I think you're just a little bit soft going into tomorrow's jobs number, So I like silver, wheat. I think gold still look okay. So I think it's all, if stocks continue to go higher, gold will go higher. And my thesis that it's all based on this environment of continued QE and lower interest rates is going to take gold stocks up as well. So I think a lot of these, I like this one. I like Newmont Mining is acting okay. You can go GG. That's trying to come back. I don't know what hit them the other day. They may not be as leveraged to the price of gold. You got to watch out if some are hedged. The miners that are heavily hedged won't be as leveraged so much to the price of gold. So other ones are Agnico, Eagle Mines, which is trying to hang in there. But I like Silver Wheaton. It's one of my favorites. So anyways, any other questions on stocks? Did we go through everything in here? Let me see. I believe we did. Did we go through Tesla? Let's see. I think that's so. No, wait. Under Armour, we did that. VMware. Twitter. Under Armour. That looks like it might be in a viable pullback position there as an ugly duckling using the 20 days as your stop. VIP shops are not working. So, again, like everything else, not 100% are going to work. VMware trying to work, but not really. And you observe, which are the ones that are acting the best. VeriSign had a pocket pivot coming up through, let's see, the 50-day line here, then pulled back in here and had another pocket pivot, I believe, on the pullback. No, I'm sorry. It was a volume dry up here 7 days ago. Now it's moved higher. And it's trying to form a base. You see that? So it's trying to round out a new base. Okay, it's not a rally of laggers because we're not in a can-slim market. Okay, so I think a lot of stuff you just need to get out of your head, and I know I have had to in order to be successful and just see what the market's doing and come up with some new methods and being open to that. So anyways, that's all I have. What is Dr. K's take on unemployment number that is better than expected? My take is I don't really care, but go ahead, Dr. K. I'll let you pontificate on that.
It doesn't matter. It really, yeah. Watch the price volume reaction to the report because if it's pronounced in either direction, that might give you a clue. But in terms of the actual number, it's pretty irrelevant. One camp will say, well, if it's a strong number, then that makes it harder for the Fed to keep rates low, and they might have to raise, and that might cause a sell-off. And if it's a very weak number, that could also cause a market to sell off saying, oh, geez, this QE isn't doing anything to resuscitate the economy. But you could use arguments in the other direction as well. So watch the price volume action. That's really what matters.
Yeah, definitely. Most of the data is manufactured anyways, So somebody's asking a question on a stock. Would you look at G-Pro for a VDU into 50-day? Look at G-Pro for a V. Okay, let me take a look at this. Let's pull it up here. Whoops, doesn't want to come up there. That makes sense. Let's put it up here. G-Pro. I don't know what you're talking about a VDU. I don't see any volume dry up in here. What you're seeing is something that's trying to turn off the lows. Now, what I probably should do is maybe blow it up a little bit. I don't know if that's going to help. Not really. Let's look at it. You can see though that it's on track to post a pocket pivot, and it's coming above the 50-day moving average. And probably the whole world is shorted. So looking at it that way, you can see here that it's trying to come off the low. So it almost has a look like Twitter. So, if you want to try, you actually have deep doo-doo pocket pivot here off the 10-day line. You have several of them here. One here 5 days ago, and it looks like another one here yesterday. And now it looks like you're heading for a pocket pivot coming up through the 50-day line today. So that looks constructive, and what you could do is, if you wanted to take a shot at it, is you buy it here using 1331 level where the 50-day is as your downside selling guide, if you wanted to do that. But again, you know where you're going to get out. My preference would be to be in at the close to the 20-day line, which is around 1190, if I can see that correctly. Let me see. No, I'm sorry, 1216. So that would be my preference, to buy it on that down along there. It gives you a little bit of a head start. That's what I did with Twitter. And Twitter's, see how they look similar? So, and a lot of these do. So they are in viable positions, and the setups can be bought, and you don't have to use a stupid, silly downside stop of 7-8%. I think that, like Dr. K was saying, a lot of people just get their head ripped off on that one. I think it's in this market where you want to control risk much more than you might normally in a nice big fat trending market. I think it's important to be able to buy things wherever you buy them, whatever setup you're using, but to buy things with a tighter reference point. So a moving average, when I can buy something with a nearby moving average as a stop, I'm very much willing to do that. So I'm watching Sedge come in a little bit. It seems normal here because you're running up to the highs, and I think you got to see how it pulls back into the 200-day line. So but I'd watch it there. That might become viable in there as it pulls in. So anyways, on G, 32% of the float is short. Yeah, there could be a short squeeze on that one. That's a possibility. So anyways, that's all we've got for now. I went through all these long shots, or these ugly duckling sort of names, and you can see what I'm talking about in terms of the type of setups that seem to be able to work in this market. And if you're going to make money on this, I think on this rally, this is what you're going to have to be looking at. And hopefully, some of these move higher and they do break out, and then we start a nice big trending bull market. I'll believe it when I see it, but for now I'm willing to play the market as it lies, which is basically a junk off the bottom or roundabout type of environment where those names are going to work. And that's what we do. So anyways, that's all we've got. You guys, thanks for showing up, and have a great weekend. We'll catch you next week. Take care.